think we're in a world where you've basically got to try and align debt to the pool of liquidity. That means that to effectively devalue debt against liquidity, you need monetary inflation, not financial repression. And what monetary inflation ultimately leads to is a continuation of this, what people have called financial nihilism, which actually is a term coined by WTFinance in the US, which I think very neatly summarizes the sort of plight that many people are in, particularly Generation Z, where houses are unaffordable. People have seem alienated from society. If you haven't got assets, you're in a really difficult position, because what this is really saying is it's not necessarily high street inflation that we're getting. It's actually asset price inflation. If you're not on the asset price, merry-go-round, you've really got a big problem. And that's really the issue. Now, if you come back to why is debt a problem, and why are we in this mess? If you look a little bit further in the presentation on slide 19, what I've tried to articulate there is really the underlying problem. And if you think about it, I mean, there's nothing wrong with debt per se. I mean, debt is the lifeblood of capitalism. If you don't have debt, you can't expand economies. So it really is a critical factor. And, most growth is really underpinned by debt and credit. So it's not necessarily a bad thing. What is a bad thing is unproductive debt. And that's the issue that we've got. Now, what slide 19 illustrates is our estimates of the underlying return on capital in the US economy. And what I've tried to show on that chart is there have really been, it really looks like a staircase or a descending staircase of returns. And if you look at the, back into the 1950s and 60s, you had, rates of 12, 13, 14% or so for a return on capital. And then you see the oil crisis in the early 1970s, where all those returns on capital sort of hit an air pocket and they drop, by about 40%. So you see, those rates going right down to about 8% or maybe even lower. And that's clearly a problem. Now, in that environment, what you need to happen is you need a debt restructuring, because a lot of debt has been taken on at the old or expected returns on capital. And so once you've got this air pocket in returns and this new world of higher energy prices, you need to devalue a lot of debt or restructure it. And that's why you need a monetary inflation. And that's exactly what we got through the 1970s, until we didn't when Paul Volcker came in to the Fed at the end of the 70s. But basically, debt was devalued. There's a second step down that I've highlighted, which was around 2001, which is China's entry into WTO, the World Trade Organization. And that is an equally large hit to returns on capital. And what it basically means is that US returns on capital dropped by another 40%, down to these lowish levels that we're seeing now. And that requires another debt restructuring, another debt monetization, if you like, devaluation of paper money, rather like what we saw in the 70s. And that is what this monetary inflation is all about. To get out of bad debt, to get out of unproductive debt, you need to print money, and that's exactly what's happening. So the US is in this process of actually monetizing debt, or the world economy, one would say, is in that process. Now, what has added a twist to that is shown on the next slide. And what that next slide highlights is the more recent plight of China. And China, through this, if you like, weaponization of the dollar, through increasing trade sanctions, technology bans, whatever, the return on capital in China, drawn equivalently but over a shorter time period, is actually collapsing. So whereas it took America something like 75 years to go from a rate of return on capital of about 14% to about 4%, the Chinese have managed it in barely 10 years. So, what you're seeing here is a very significant collapse in Chinese returns on capital. I mean, you can see from the chart that America's return on capital is beginning to pick up a little bit. I mean, it's actually probably higher now than what you're seeing in China. Germany is in a bad situation, but let's not go there. And that's probably, symptomatic of the rest of Europe. But it's that return on capital in China which has collapsed. Therefore, China needs a debt restructuring. It needs a big monetization. And that's what we're talking about. And if you work out the maths of that, which is shown on the following slide, slide 21, what that is comparing is debt to liquidity ratios, not debt to GDP ratios. Now, what that chart basically, or those charts suggest, is that there is an underlying equilibrium between debt and liquidity. And that underlying equilibrium has to be honored. And you can see, those different ratios to different countries. But if you start to look at China, China probably needs something like a 30% expansion in its liquidity base to devalue existing debt. And that's a benchmark as to what the yuan should devalue again. That's how much it should devalue against gold. Now, the black lines on those charts are debt GDP ratios. And debt GDP ratios are just completely meaningless as far as I can see. I mean, academics have told us, or they warned us, whatever it was 15 years ago, that 90% was the critical threshold and the world would end after 90%. Well, here we are at sort of, sky high levels in Japan, China, Singapore, and other Asian countries. You've got much higher than 90% rates in most of the West generally. And the world still, goes to work every day. So debt GDP is not really the bogey or the hurdle that we need to think about. It's debt to liquidity.